The major averages coming off back-to-back positive weeks. Of course, that was helped by Friday's rally on Fed Chair Powell's comments signaling rate cuts ahead. For more on the markets, we're joined by Jon Mackay, U.S. Head of Wealth at Schroders. John, good to see you here.
Good to see you.
Markets seem to feel as if maybe, we've kind of nailed this thing, that there isn't really a serious trade-off to be worried about at this point in terms of where rates go relative to the economy, relative to earnings, relative to stocks. Where do you fit within all of that?
I'm a little concerned. I hate to be a Debbie Downer, but I'm a little concerned about the rally we've seen over the last 3 weeks. It's almost like the market thinks the Fed knows exactly how many cuts they're going to do, and I'd be, willing to bet that Powell and the other Fed members don't know, right? The Fed is uncertain. Powell said rate cuts are coming, but he didn't elaborate on that. He didn't say we're getting 50 in September or 25, and he certainly didn't elaborate on the pace of rate cuts. And as we've seen in the past, the Fed puts out this summary of economic projections, the set, which shows the consensus view of where Fed fund rates are going. They usually get it wrong. And so I think there's a lot more certainty priced into the market than what we'll get out of the Fed in September.
Although there is a school of thought that says without knowing or even pretending to know exactly how far or fast rates might go down, the Fed has a couple of 100 basis points of what it believes to be excess restrictiveness in their policy. And therefore, the direction is that's a cushion if things perhaps don't go right with the economy.
I would agree with that. But I think, again, getting back to the market's pricing in roughly 100 bips between now and the end of the year. We've got 3 meetings, so that implies you get 1 meeting where there's 50 bips. And I think the problem is, what if we get a good labor report for August in early September? I think that throws the market's pricing off a little bit. And so, again, it gets back to a little bit too much optimism probably priced in the market right now. Valuations are high heading into this cutting cycle to begin with. There's a lot of crowding in the market. And so I think you could get a little bit more volatility between now and the Fed meeting in September.
Where does that take you in terms of, wanting to, lean in your portfolios? I mean, if you think that things are crowded in terms of certain assumptions, where else would you go?
Super boring. Boring is beautiful. Look, the Fed's cutting rates because the labor market is weakening, right? Powell said as much.
Well, they would say they're cutting rates because inflation is on the way to target.
But he also said that he doesn't want to see any more deterioration in the labor market. So it's sort of shifting focus from inflation, a focus on inflation, to a focus on the labor market. So if we do get better than expected employment numbers, I think it will still allow the Fed to cut rates, but maybe not at the pace the market was expecting. And so, again, getting back to areas of the market that aren't crowded, aren't overly priced, consumer staples. We all need soap, shampoo, and toothpaste. Pretty boring stuff, but those areas of the market that have done well, if you look back at when the inflation report came out in July, on July 10th, that was sort of a clear signal to the market the Fed could start cutting rates. Consumer staples, utilities, REITs have all done better than infotech, communications, and some of the more crowded areas of the market. And so I think it's just worth looking at your portfolio and saying, do I have enough, right? Do I have an umbrella in case there's more market volatility and more storms coming?
Mm-hmm. So, when Powell says it's time for policy to adjust, you don't necessarily read that as it's time in September. You think there is a possibility that, that policy adjustment could take place further in the future? And if so, what does that mean for market volatility?
So I still think we get a rate cut in September almost no matter what. You would have to get unbelievably strong labor market numbers, really good inflation numbers to the downside between now and then for the Fed to be able to credibly get up there and say, we're good, we can hold off for another meeting. What I think it does is it probably shifts the market expectations for how much rate cuts you get over the next 4 months between now and the end of the year and how much you might get next year. The market's effectively pricing in 200 bips between now and the end of next year, and that might be too optimistic.
Although it always seems to be once you know the direction, and the Fed has signaled that very clearly, the market's always going to say, well, if we're wrong exactly, it's probably going to skew to the downside, or at least that's the direction of overshoot. So I just wonder how important that is, because we priced in 6 cuts in January that were supposed to happen this year. Didn't happen. The stock market didn't exactly have too much trouble with that.
So you're 100% correct, right? The Fed, I think, has to wait for data to come in. It's also a consensus, right? You have to follow the lead of Powell, but it's a committee, so they all have to agree. And you've gone from, I'm generalizing here, roughly half hawks, half doves, to more dovish voters on the committee now. But I think just remember back to the hiking cycle. It was 25, 50, and then suddenly 75. And so the Fed had to catch up to the pace of inflation, and you may see something like that happening on the way down. I just think what drives me nuts is the market thinks it's figured it out. We know exactly how many cuts we're going to get between now and the end of the year. And I think we can all sit here and say no one knows for sure.
Yeah. I guess, do you feel like you have to convince your clients to hold less cash? Like, what's the line that you feel like you have to emphasize most to them at this point?
The toughest thing is getting away from the winners, right? It's not fun to go to a cocktail party and say, hey, I bought a consumer staples company that makes your shampoo. Yeah. It's super fun to go to a cocktail party and say, I bought a company that makes the leading edge chip used in artificial intelligence. So it's more about, are you still diversified? Have you let your winners run? And is it time to pare some of that back? I think cash is an interesting point, right? Flexibility and the return you're getting on cash is a good thing in this market. I just wouldn't hold too much of it because those rates will come down fairly quickly along with the Fed. And it's just looking at areas of the market that may not have been as much fun to own over the last year, 2 years plus.